Welcome back to All Things Money. I'm David Blain, and during this segment we're going to be talking about taxes and some of the sneaky ways that government puts some more taxes on you. As you've probably heard, President Obama is planning to raise taxes on upper income taxpayers as well as institute a new tax on all earnings, a Medicare tax on all earnings. Yet the federal deficit is probably going to continue to explode. They're going to impose new taxes on multinational firms, banks, oil companies, hedge funds, private equity firms, and these taxes won't even make a dent in the federal deficit. And so what we're going to talk about today is some of the sneaky ways that government is going to be raising taxes on the rest of us. People that aren't earning, millions and millions of dollars a year, but what most people typically call the middle class. Taxing the rich is always a popular political thing that politicians use to get reelected. Oh, we're just going to make the rich pay for it. Doing taxes, it's amazing how far down the income scale that usually ends up drifting, and that you're just average people end up being caught up in these taxes on the rich. At least 35 states this year are facing major budget shortfalls in their own budgets. Revenues coming in way below projections, and politicians are having a hard time figuring out what to do. Of course, here in North Carolina, they instituted a surtax on singles earning over $100,000 a year and couples earning over $250,000 a year. There's a 1% and a 2% surtax now. And in addition to the surtax, there are some other ways to raise taxes. Of course, expansion of existing taxes. Bumping the sales tax slightly is a very popular way to raise taxes on everyone. Sneaking in a quarter of a cent tax on the sale of items, or a lot of times they will include things that were previously excluded. So, for example, restaurant meals, salons, services, internet, phone, cable, TV. These are things that the politicians can raise the taxes on, and many people don't even notice or know that their taxes are raised. But it's a way that they can raise money. Another way that they do it is by raising taxes on what we call avoidable taxes. They're things that you don't have to purchase if you don't want. I mean, the gas tax is one. Everybody needs to put gas in their car, but once again, they can raise the gas tax without too much political fallout. Of course, anybody that still smokes or drinks alcohol, these are favorite targets of states to raise the taxes on what they call the sin taxes. Online taxes, this is a big area that is coming to the forefront, and North Carolina is one of the states that's sort of leading the charge to capture sales tax from online retailers, which traditionally, whether it be catalog or online, traditionally have been exempt from sales tax if they don't have a presence in that particular state. This is part of a larger issue of what we call nexus, and nexus is a connection or business connection to a state, and states are being very aggressive about targeting businesses to create a nexus to their state, which then allows them to charge sales taxes and business taxes and income taxes on that. Traditionally, if you didn't have a physical presence in a state, you were exempt. Well, states are becoming very aggressive about trying to capture some of these businesses that don't physically located in the state but do business in their state. Some other sneaky taxes, healthcare taxes, starting to tax hospitals as well as medical devices and some other things, raising taxes. Less federal aid to the states is an indirect way of raising taxes by keeping more of the money at the federal level and giving less aid to the states is an indirect way of raising the taxes. Of course, businesses are, like the rich, businesses are a favorite target to raise the taxes. Businesses pay personal property tax every year on the furniture that they own, on the equipment like the TV camera that I'm looking at now. The TV station owner pays tax on that camera every single year, year after year. Not only do they pay sales tax when they bought it, but they pay personal property tax on it every year. You also heard a lot recently about what's called the value-added tax, and I wanted to take a minute to talk about that. Oh, before I forget, I just heard this morning, I was talking to somebody, or heard on the radio, they were talking about taxing tanning beds. And I was just thinking about how that may be construed as discriminatory tax on white women, since they're the majority users of tanning beds. But you know, they're coming up with different ideas to tax just about anything. So what is a VAT tax? A VAT tax is a value-added tax. It's being bantered around Congress right now, possibly the U.S. instituting a value-added tax. And let me just point out, a value-added tax on top of our tax structure now would be just disastrous. What a value-added tax does is at every stage of the manufacturing cycle, let's take here in New Bern, Bosch, for example, they make dishwashers. Well, when the mining company mines the aluminum out of the ground and sells it to an aluminum company to make aluminum sheets, there would be a tax added to that. When the aluminum company takes that aluminum sheet and sells it to Bosch to stamp into dishwashers, well, there would be a tax added to that. And so the VAT tax is added at every level of the production cycle. And then at the end, when the consumer buys the product, unlike a sales tax, it doesn't say, 20% VAT tax. It's just embedded in the cost. Right now, the average VAT rate in the European Union is 19.8%. And so the average cost of a dishwasher or whatever in Europe is 19.8% higher than it would normally be thanks to the VAT. And so we are a little bit skeptical of adding the VAT to our already high taxes. So that brings us to our next break. When we come back, we'll get to our mailbag. For All Things Money, I'm David Blain.